Okay, so today we are joining together for preparing for tax season, closing out the books, and preparing for 2024. As I mentioned, we are recording today's workshop, and we will send you the recording after today's presentation is over. This presentation is scheduled for an hour, and we encourage you to use the chat. Feel free to introduce yourself. If you have questions, you're welcome to post them there, or you can raise your hand. And at the end, we'll have time for you to unmute and have those questions answered by our presenter, Tom, who I will introduce in just a few minutes. And if you will, keep your microphone muted while we're recording. That way we get a clean recording and you guys have access to that as well. If you would like the closed captioning on, I'm happy to do that. You can also, if I turn it on, you're welcome to turn that off as well. And of course, grab a paper and take notes, or take notes on your keyboard, however that works best for you. All right, Tom, if you will move on to the next slide, please. Me and my colleagues are a small and mighty team. We serve businesses throughout the greater Roanoke Valley, Franklin County, the New River Valley, Allegheny Highlands. And we are part of the Virginia SBDC network, which is comprised of 27 different centers across the state of Virginia. And there's an SBDC near you. As I was reading through the list of folks that are joining us from all over the state, there is an SBDC near your business. And we're happy. I'm glad to send a virtual introduction. If you have not connected with your local SBDC, we'll be glad to get you connected. Feel free, and I'll post our information in the chat for you as well once I get done sharing these opening remarks. Well, we offer a lot of workshops and training. Like I said, I encourage you to get matched with one of our advisors. We become your back pocket secret weapon for all things business. Also on the screen, you'll see a link to a couple different resources. In your follow-up email, you'll receive a link to our resource library that's open to anyone, any business owner or aspiring entrepreneur. So feel free to share that, take advantage of that. There's lots of great resources for you. And if you are in our region, we'd love to work with you one-on-one if you need support. And Tom, if you'll advance to the next slide. This shows you just a quick snapshot of our advisor match. I will post a link to that page in the chat. And Tom, if you will scoot to the next slide. And we work with businesses through all stages of your business ownership journey. And it feels like this up and down and wild ride of being an entrepreneur, as you all know. But we look forward to supporting you through all of those different stages throughout the life of your business. All right, Tom, next slide, please. And we are funded in part through a cooperative agreement with the United States Small Business Administration, supported by America's SBDC, the Virginia SBDC, the Mason Enterprise Center at George Mason University, and our local host is the city of Roanoke. Next slide, please. And it's my pleasure to introduce to you Tom Tanner, my colleague, and I call him the GOAT, the greatest of all time in the SBDC. He has an incredible knowledge, just a wealth of knowledge and information, and a great resource, and has been with the SBDC for a long time. And I am so excited that he's here today, and I look forward to turning the conversation back over to Tom, and I will be here as your host and managing the chat. So feel free to post anything you need in there, and we will rock and roll. So Tom, take it away.
All right. Good morning, everyone. As Heather mentioned, it's hard to believe that we are almost at the end of the year. It seems like we were just in summer a few months ago, or a few weeks ago, actually. So unfortunately, this time of the year means it's time to close out your books, think about how to write off expenses and things like that. And that's what we're here to talk about today. Not the most exciting topic in the world, but one that's important. Thank you for filling out the poll. It gives me a chance to see that it looks like a majority of the individuals who are here are basically been in business less than a year, or certainly less than 3 years, almost everybody. And that most of everybody here either are single members, or they have less than 5 employees. So that helps me kind of figure out when I'm talking of who my audience is here. I'm going to share the results just so you can also see. So a lot of the information I'm talking about, I'll try to shape it to that particular audience, even though there are going to be discussions about things about employees and things like that. If you don't have employees, just skip through that stuff. And there'll probably be information in here that I may not even cover or I may skip through, primarily because I'll give you access to this slide deck so that if you want to dig deeper into it, then you can look into it. Plus, you can always reach out to us to ask any questions. Let me stop sharing, close this thing out. And just as part of my typical requirement that this is for educational purposes, it's not considered legal accounting or tax advice. All right. So what are we going to talk about today, or at least going to kind of cover some of the stuff? So some of the items about running financial statements at the end of the year, reconciling your books, make sure you're taking proper deductions, consider additional expenditures for the year. Looking at your billing, both billing and payments. Are you taking home office deductions? If you have employees, different additional benefits, health insurance and retirement plan options, possible legal and tax structure changes. And we're going to talk about estimated tax payments, which you may or may not be doing now, and you maybe should be doing. So let's jump into some other stuff. All right, so the first thing is one of the first things you should be doing is getting close to the year. You should be running a profit and loss statement. And I noticed that in the poll there, a lot of you or a few of you are just basically using spreadsheets. At some time as your business grows, you're probably going to need to convert to some sort of computerized bookkeeping system. But even with a spreadsheet, you can still kind of put together how you're looking from a profit and loss standpoint. But the primary thing I'm talking about here is allow you to look at all your information from your expenses to your income to see if there's any obvious errors that are sticking out. And the same thing for your balance sheet. Look for obvious errors such as undeposited funds, and that applies mostly to QuickBooks. Inventory may be out of whack, banknotes too high, and we'll talk about a few of these. And negative balance where you're positive. You should be positive balance. So let's just take an example. Here is a comparison of 22 to 23. And of course, if you've only been in business 1 year, you're not going to have a comparison. But a comparison is a great way to look at your books to see if something's out of whack. Perfect example is if we look at this one here, we're noticing that our cost percentage of sales or our gross profit in 22 was 70%, and in 23 it's 62%. So that means we need to dig a little deeper to see if one, we made a mistake somewhere and we need to fix it. In other words, our cost of goods are off or something like that. Or is our pricing structure not correct? In other words, in 2023, we know prices went up on almost all our costs. Did we not raise our prices to compensate for that? And that will give you a chance to go, okay, I can't do anything about 23 now, but going into 24, I need to make sure I try to get back to maintaining that 70% of cost of goods. If you don't, then you're never going to get back into the same profit situation. Or it could be, like I said, it could be an error in bookkeeping that you put something towards cost of goods that shouldn't have been cost of goods, or you miscounted inventory, or something happened. So those are things that you just want to look at. And if you go down the list, there's another one like utilities. Utilities is showing $21,000 versus $6,000 last year. Is there an error? Did you have some problems? Is there a reason behind that? And I just throw these out there because it could be any category. out there, but just look at those expenses. And of course, the biggest thing is looking at your bottom net line profit. For this case here in 2022, you had a 14.5% profit and you only had 1.8% in 2023. That's a large drop. So you need to figure out, is this a bookkeeping error or is this an actual that you just spent more money than you made last year compared to the previous year? Now, if you weren't in business in 2022, then there are benchmarking numbers that we may be able to help you pull up. You could talk to your SBDC advisor and see if they can help you determine what that cost of goods number should be, where your numbers should be at, and that will give you at least an idea of, is my cost of goods should be at 70% and I'm at 62, then I need to figure out what's going on. And then if you look at your balance sheet, which is where you're going to have your assets and liabilities, some of the obvious things you want to see is, okay, maybe you got an old checking account that shows minus $6,000 on your balance sheet. Well, you know that's not correct because you're not going to have minus $6,000 in a bank account. So somewhere there's an error that you've got to find and try to fix. The same thing with this credit card for $2,000 minus, is that something's going on that needs to be fixed. Another error could be, there's a minus $6,500 in inventory. Well, good and well, you're not going to have a minus inventory. So you need to search out and figure out what's going on with these particular items. And the last is, again, this has to do with more with people who are on QuickBooks, because they use this particular term called undeposited funds, where it's a deposit being held. And if you have a large number in here, then you've got something's messed up in your accounting system that you need to fix, because that's a major issue there. All right, if we look at the liability section, you may go down here and go, okay, what's going on here? Well, I got minus $3,500 in payroll taxes. Something strange going on there, because typically I wouldn't pay the government more than I'm supposed to owe. So is there something going on there we need to reach into and figure out what's going on? Another big one happens is bank notes. So if you put a bank note, you borrow $10,000 for a new piece of equipment, and during the year, you've been applying that $10,000 to your bank note, and that's your payments. Well, those payments also include interest. So what's happening is that this number is going below the balance because it's also included interest. So you need to do a little research and figure out, okay, is that $2,000, is that actually a deductible expense that I need to move to my expenses so that I get that $2,000 deducts as an interest expense. So again, those are little things that are very important to look at. At the minimum, you should be looking at any of these banknotes and pulling out the actual balance from the bank statement on December 31st to make sure that what your balance sheet says is your balance on your banknote is what you have in your balance sheet. Because the difference is most likely interest expense that should have been transferred over. Another one, which again, if you're using QuickBooks, is this open balance equity. I see this a lot when I go into looking at clients' QuickBooks files, and I see this number here, and this number should be 0. If there's anything in there, it's because you set up QuickBooks from an existing company, and it basically created balances that were already there, which you need to move to where it belongs. In other words, you might have set up a new bank account and started the bank account at 0, but in fact, the bank account had $5,000 in it. So QuickBooks just automatically generates this particular account and throws money into it. So you have to back it out of here. So anyway, this is again, just an alert to say, oh, I got something in here. I need to figure out what it is, or make sure my accountant does something about it, or my tax guy does something about it. so that we can fix that. All right. You also want to reconcile your bank accounts. And this is whether you're on a manual system or a computerized system. You want to be reconciling all your bank accounts on a monthly basis. And I'm sure everybody here does that. I'm not going to ask you, but I'm sure everybody does that. So it's very important to do that. And if it's done every month, it's surprisingly how easy it is to do it. It's when you don't do it for a while when it gets really complicated, because when you finally get ready to do it and something's messed up, it takes you a long time to try to fix it because you don't know which month it occurred in. And if you're using something like Square or any sort of POS system, you also want to match your numbers to say, if I run my numbers in Square as my sales, and then I look at my QuickBooks, if I'm using QuickBooks, those numbers should match pretty accordingly. Or if you're using a spreadsheet and you're using Square, you want to make sure that Square says I did $10,000. I want to make sure my spreadsheet doesn't say that I did $20,000 or vice versa, because those things should match if that's the only thing you're using. Now, if you're using Square only for credit card transactions, then it obviously would probably be less than your deposits would be. But those, again, is something else to check. All right. For 2023, there's this new form that if you're taking any sort of credit cards, you're going to see this form. It's called a 1099-K. And basically, if you receive $600 or more from any third-party processor, Square, Toast, anybody who processes credit card, and this could be eBay, it could be Amazon, anybody like that. If they process credit cards, they're going to send you this 1099-K for $600. And just to show you what it looks like, that's what the form looks like. And it's going to show each month of activity and how much in each month. All right. First of all, don't freak out when you get it, because it may not have any bearing on you. So if you have a business where 100% of your business is credit cards, then that's when you have to pay attention to this. Because let's just take an example. Let's say all your business comes from credit cards. Let's say it was $50,000 in credit cards that you did, and that's all your business. Well, your third-party credit card, your 1099 is going to show $50,000. Well, you didn't receive $50,000. You might have had sales of $50,000, but you didn't receive it because it's including sales tax, it's including shipping charges. Most of all, it's including merchant fees. So if you're using Square, Square will send you down the net after their merchant fees. So that $50,000 may have actually only been $48,000 that you physically received. Well, you don't want to be reporting on your tax return $48,000 if your 1099 says $50,000. So that's the one thing you've got to be kind of beware of is making sure that your tax return income shows at least what it shows on the 1099-K or more than. If your credit card processing, and you might get multiple 1099-Ks because you may have multiple processors. You may have Square, but you might have Stripe, you might have other MasterCard Visa processors or whatever. If you add all of those up, and your total from all of those is $50,000, but your total from sales from your other customers who paid check, paid cash, and everything else is $100,000, then you could really ignore this form because it has no bearing. It's only when you're trying to report income where the 1099-K is larger than what your net income is actually showing that you're going to show in your tax return. I know that's a little confusing, but just remember, this has no bearing or it's not going to affect you in any way if your sales are going to be greater than what all your 1099Ks are. All right. This is just another sample exec. Maybe you send out a lot of customers to invoices to customers who pay you, and then they're going to send, they could possibly be sending 1099 to you because they paid you more than $600 on a 1099 NEC, which we'll talk about in a second. So let's just take an example. Your business sends this customer an invoice for $2,200. This customer pays you by cash or check $1,200. But he also runs $1,000 through credit card processing because he wants to pay off the whole $2,200. So your customer is required to send you a 1099 because it was more than $600 in a year. Well, this customer may not understand the system and is going to send you an NEC, a 1099 NEC for $2,200 because that's the amount he paid you. That's incorrect. They should be sending you a 1099 for $1,200. And then the credit card company is going to send you one for the $1,000. Now, if you got one client, it's no big deal. But if you got hundreds of clients and every client is sending the 1099 incorrectly, you're going to have a 1099K that's going to be a lot greater than what your actual income is. So if you run into this case, you need to notify the customer that they did their 1099 incorrectly so that they can fix it. Hopefully that is somewhat straight. When we get to the question and answer, I'm sure people are going to have questions about this because it's pretty confusing. And again, it's going to apply to if you're selling stuff on eBay personally and it's more than $600, eBay is going to send you a 1099K. So there's all kind of issues they're going to come up with this particular program. All right, so the NEC, again, which we were just talking about, which you may get because you did services for somebody else. All right, the opposite also happens is if somebody does services for you, again, this is services, it's not products, it's services. So somebody comes in and provides computer services, somebody comes in and paints, or somebody comes in and does something of a service nature for you, and it's for more than $600, you're required to file a 1099 NEC for each of those vendors prior to January 31st. These are very important that you do it because there's a fairly large fine for not doing it. So this is just what the form looks like.
Tom, we lost your audio.
Oh, you there?
There we go.
All right, where'd you lose me at?
When you were finishing saying this is what the form looks like, and then
Okay. All right, sorry about that. So you're going to have the taxpayer's employee identification number or their social security number. If you do not have that, you're not going to be able to complete this form. Okay, so how do you get that information? So what you have to do, and some of you have probably filled one of these forms out before. This is called a W-9 form. It's a request for taxpayer identification number. Okay, if you're going to pay anybody that you know is going to be more than $600, then you need to get a copy of this form. And this is the most important part. You need to get a copy of this form before you pay them. Because if you wait till after you pay them, you may never get their information because they don't necessarily want to get a 1099. So always have them complete this form prior to you paying them. And this would include their social security number or their employer identification number. Either one of them will work. So just remember W-9s. There's also a form 1099 miscellaneous, which most people don't do, even though they're required to do. And primarily, if you pay rent to anybody from a business standpoint, you're supposed to provide a $600, over $600, you're supposed to be providing them a 1099 miscellaneous. And this also applies to attorneys. If you pay an attorney more than $600 a year, you're supposed to be filling out a 1099 miscellaneous. So just letting you know about that one too. That's just what that one looks like. All right, so let's talk about deductions. So most important it is making sure that you're taking proper deductions. One is making sure you're taking all the deductions you can take, and also not taking deductions you shouldn't take. So the IRS uses this term, ordinary and necessary expenses. So ordinary expenses means that if you looked at another business or other businesses like yours, is this an ordinary expense that that business would have to incur in order to run their business? Additionally, is that expense necessary for you to run the business? So those are the two terms you need to look at. And let me just give you an example. Let's just say you're a plumber and you need to buy a new hammer drill because you drill holes in concrete walls to put pipes in. Okay. Is that considered an ordinary expense for other plumbers, or especially other plumbers similar to your size? Sure. Most plumbers are going to have a hammer drilled to do this kind of work. And is it necessary? Sure, because in order for you to complete your work, it's necessary to do that. All right, let's just say this same plumber, single guy, he just operates by himself, goes into Best Buy and sees a 120-inch flat screen TV, and he says, I like to have that, and I think that would be perfect so I could watch YouTube videos on how to do plumbing. So that's the way he justifies it. So now we look at it and go, okay, if we look at other plumbers that are single individuals or small type of plumbing business, is this an ordinary expense that most of them would use? And pretty much not. Okay. Well, we can go to the next one. Is it necessary for him to have this? Well, even if you could justify the fact that being able to have some way to review YouTube videos to help him could be made a case, but you would have to look at it and say, okay, do you really need a 100-inch screen TV? Can you just use your phone, or can you use a tablet or something? And that would be very difficult to justify for what it is. So that's the way you kind of have to look at it. So always look at any expense you have and go, is this something I need to do my business? And is it something that other people in a similar business would be required to do? And I get people ask me questions about things that they ask if it's deductible. I've had people come in and ask me, can I deduct my business cards? Sure, because it's typical business expense. I mean, most expenses that you incur in your business are going to be deductible if you just look at common sense, if it's required to do your business. Where it doesn't make sense, if you know good and well you're buying this for your own personal purposes, it's probably not deductible. Okay. The other thing you got to be thinking about is mileage. This is one that a lot of people do not do appropriately for both the accountability, which in order to really account for your mileage, you need to be logging in every trip for the date, the number of miles, and the purpose of that trip. And that will let you deduct that mileage or be reimbursed for that mileage And for 2023, it was 65.5 cents. So that's a pretty, if you drive 1,000 miles, that's a $650 that you're getting reimbursed for, or you're subtracting out of your gross income. Again, that's, of course, if you're taking mileage rate, you can't take anything else. You can't take gas, you can't take maintenance or tires or anything else. It's a flat rate. Now, if you're using your business primarily for business, then you may want to be taking actual expenses for it. But if you're using it for personal use, especially if it's above 50%, it probably doesn't make sense. But if you're using it just for a few miles here and there, then your actual expenses may make sense. Or you could try both ways and see which makes sense. All right, other deductions is travel, health insurance, and there's different ways you can handle health insurance. If you're a sole proprietor, you can take it off on your 1040 tax return. You can't take it on your personal Schedule C tax return. If you're a corporation, then it comes off your personal tax return. Unless you're an S corporation, then it comes up there. But anyway, purpose of it is making sure you take advantage of writing off your health insurance. And there's some stipulations that you can't write off health insurance on your personal from your business if it's available through a spouse or something else. Meals. And I just put this in there. I'm not going to go through each one of these, but if you want some detail of, is a meal 100% deductible or is it 50% deductible? For 2023, most of it's going to be 50% deductible, if it's deductible at all. So you can kind of go through this when you send this back out to you and let you kind of read through it. All right, so let's now talk about year-end purchases. This is what really can make a big difference. So if you're running your
Tom, we lost your audio again.
I'm sorry. If you are running your profit and loss statement, let's just say right now, it's middle of November, and you're noticing you've got a fairly significant amount of profit for the year, so that means you're going to have a significant amount of taxable income. You may look at it and go, okay, is there any equipment that I need to look at purchasing for my business? Well, this might be the best time to do it before the end of the year, so I can possibly write off part of it or not all of it for this year, so that will reduce my taxable income. Contrary to that, you may run your profit and loss statement, and this being your first year or second year, you may be showing a loss or almost a loss. Maybe it's just a small profit, but you want to buy a new computer or a new piece of equipment that's $3,000 or $4,000. Then in some cases, it might be better off to wait until January, because next year may be a higher income year, which you would want to write off that particular piece of equipment in the following year, not in the current year. For most businesses, especially if you're a sole proprietor or a partnership, so you're a complete pass-through entity, you have to be careful about going below zero. In other words, you don't necessarily want to show a loss on your tax return as a sole proprietor unless you have to. I mean, there's no way around it. But if you're going to show a negative because you bought a piece of equipment, hold off on doing that. Now, if you got a bunch of profit, then there's multiple things you can do. You can purchase vehicles, you can purchase equipment, software, all that stuff. And there's multiple advantages to doing where you can take almost 100% of the purchase price off on the year that you bought it, using both what we call a Section 179 and bonus depreciation, unless you have vehicles. Vehicles, you cannot do that, but you can take still a decent deduction. So if you have, $40,000 worth of profit, you're going to buy a $50,000 piece of equipment, then you can just about wipe out your entire profit for the year with no taxable income. Again, it might make sense to do that, or it might make sense to say, do I not take it? And just maybe I go ahead and buy the equipment, but I don't take these additional deductions, these additional accelerated depreciation deductions, because I'd rather have that money left over to depreciate it next year and the year after, because it'll give me tax advantages going forward in the future. Okay. So these are kind of discussions. If you're getting close to the end of the year and you've got profit, talk to your tax person and go into detail as, what's the pros and cons of doing it both ways. You do have to place it in service before the year end. So if you buy a piece of equipment, it has to be in service before the end of the year. Even if you got it and it's not in service, in other words, if you buy a piece of equipment, but the manufacturer is not installing until January, you're not going to be able to write it off in 2023. It also requires, it has to do with qualified improvement property, which basically means if you're improving the inside of a commercial property. Okay, we already talked about the bonus. All right. So let's talk about schedule billing accounts payable. So this will be the same thing. Let's look at it and go, all right, I've made a lot of money this year. I'm going to have a lot of taxable income. Maybe I should hold off on sending some invoices till January, because I'd rather pass the taxable income to the next year. Maybe you just have a gigantic job that came in December that you have the option to send an invoice, or you can wait till January to send it. You just have to decide in looking at your numbers to see, does it make more sense to send it in 23 or send it in 24? And the same thing applies to paying a bill. Maybe you have a large bill that can be paid in December, but it can also be paid in January. So maybe you bought have an inventory item. Well, inventory is not a good example. Let's just say you have a large expense that you purchased and you go, well, let me see here. I've got, this year I've had a lot of expenses. I'm not going to have a lot of taxable income. Maybe I'll just wait till January to pay this bill, because I know next year is going to be a very profitable year. And because of that, I'd rather have the deduction in 2024 versus 2023. So those are the two things that you really kind of play with when you get close to the end of the year. You can even prepay certain things like rent, insurance, lease payments. You can't pay it for more than 12 months, and you can't pay it past the end of next year, but you can do a 12-month rule. So you can pay these things in advance. The disadvantage is if you pay it this year, you lose the tax deduction next year. So you do have to kind of think about whether or not it makes sense for you to do that. There also, since all of you out here are probably cash basis taxpayers, which basically means that you recognize income when you physically get paid, and you recognize expenses when you physically pay somebody. So it's not when you receive a bill, it's when you physically pay a bill. So you have to be thinking about what we call this constructive receipt. So let's take income, because income is usually the most widely used. Is that if you get a check in the mail on December 23rd for $10,000, you go, dang, I made a lot of money this year. I don't know if I want to count that in 2023. Well, unfortunately, you've received the check. So it doesn't matter whether it's deposited or not. It's a matter that you have control over the money. So you have to deposit it. You can't just stack them all in your drawer and go, okay, I'm hiding those because nobody knows they're there or whatever. And I'm giving you technical definitions. So if you have control over that money, it's considered income in your business.
Okay.
And the same thing applies as when you making a payment. If you have no longer control of that check, in other words, As soon as it's not when you write the check, it's when you stick the check in the mail and you can't bring it back. That's when you can write it off as an expense. Okay, so those are just two terms you have to be familiar with. So it's not the cutting of the check if you print checks off. It's not the writing of the check. It's the sticking the check in the mail or pushing the button that says send my e-check to this particular client. All right, home office deduction may or may not apply to some of you, but I just want to kind of go over it. In order to take the home office deduction, it has to be exclusive and regular use. It has to be your principal place of business. There's multiple ways you can do that. You can take basically flat $5 a square foot, or you can take indirect expenses based on the percentage ownership, percentage of your particular location. So if you have 100 square feet and your house is 1,000 square feet, then you can take 10% of that particular location. All right. If you're set up as a S corporation, a little bit more difficult. You can't just do it as a write-off, because you have to basically do what we call an accountable reimbursement plan, which is the same thing as if you pay for something personally, you have to get reimbursed from the company. The same thing applies to home office deductions. All right. You also want to be thinking about benefit retirement programs. If you have employees, these are just some of the options that you have. Health insurance options, you can pay it by the company. If you're a single owner, single member, then you can look at, does the ACA make sense for you, where you get a premium tax credit. If you have employees and you're trying to decide whether or not to take out health care, another option is what we call a qualified small employer health reimbursement account. And this can provide reimbursement coverage too. It's not a health insurance program. It's basically, you're going to set up a program for employees that you're going to pay them to go buy their own insurance. So that's just another option that you can look at. Retirement programs is something everybody should be looking at. If you have, especially if you're a single member person, there's multiple options. If you have employees, all of these are still options. It's the difference is that if you contribute a certain percentage to your own account, you got to do the same thing for your employees. So some of the options are like SEP, IRA, simplified employee pension programs. You have simple programs, which these are contributable by the employee and the employer. You have a solo 401k, which is if you're a single member company with no employees, this is by far the best deal, because you can contribute just a gigantic amount of income to these things if you're trying to do retirement programs. So the other things to think about, if you have children, these again, some tax saving things, and they're under 18, then you can hire them as an employee. You don't have to pay Social Security, Medicare taxes. You don't have to pay unemployment for them. And if they make less than $13,000, then they don't have to file a tax return because it's less than the standard deduction for them. So this is a way to get money out of your company to your spouse, to your employees, family members, without them having to pay tax on it. Now, if you can't just put somebody on there if they're not actually earning something. In other words, if you can't just do it because they exist, they have to be actually performing a service. So you can't put a 6-month child on and pay them $13,000 a year. I don't think you can get away with that. Now, you may be able to do some creative stuff like, take your 3-year-old kid and take pictures of them using your product and pay them a marketing fee or something, but you're not going to pay them $13,000 to do that. But again, you use some creative things. Charitable giving. Just remember that donations from a company is not tax deductible to the company. And this applies to a Schedule C, partnership, or an S corporation, that any donations made by the company are not taxable deductible to the company. They pass over to the employee, to the owner, that they have to take off on their own personal tax return. Well, most people nowadays don't file itemized taxes, so they lose it. So the question I always ask clients is, if you gave this $1,000 to a particular organization, what was it for? And they go, well, I'm sponsoring a baseball team or softball little league team who is putting my name on their jerseys. Well, that's probably a marketing expense, and that marketing expense would therefore be deductible. Just again, that's something else to look at. Business gifts, you got to be careful not to do too much. Inventory, you should always do an inventory. If you have inventory, make sure you do an inventory at the end of the year. And if you've got worthless inventory or missing inventory, that you're writing that stuff off. So I'm not going to go over this whole conversion to an S corporation. I put the information in there. If you have questions, I would reach out to your, especially as I'm limited on time, I would reach out to your SBDC representative to kind of go through the process of converting to an S corporation, if it makes sense. But this is time to do it. You have till March 15th to convert in 2024. For 2023, you can if this is basically your first year. But for most of you, it's probably going to be, if you're thinking about converting, it'd be 2024. But this is something else to consider. And if you have questions and your advisor is not familiar with them, reach out to me. I'm very familiar with this whole situation. But I'll give you some examples in here. I've actually created a class on doing an S corporation. I just haven't finished it yet, but this is information coming from it. I was hoping to get finished this year. I may still, I don't know. So this will show you some examples, et cetera, et cetera. Also, just a real quick talk about sales tax. And not that it has anything to do with year end, but it does come back to say, if you're in a business that sells a particular product and you're collecting sales tax from the customer, then you do realize, and most of you do, but some people don't realize, you're not subject to sales tax on the products that you buy that you're reselling to customers. And this will include packaging materials and things like that. So I've had clients come up and say, well, I've been paying sales tax since day one on products that I'm reselling, but you don't have to. And it's also important to note that if you are in the wholesale business, in other words, you're making a product, you sell it to somebody else who in turn is going to sell it to a customer, they're tax exempt. Well, for them to be tax exempt, they need to provide you a form that says they are tax exempt. And it's one of these forms listed here, this ST10 or 11, or depending on which one. Typically, it's an ST10. So just remember, make sure you have those forms on file. And there's a grocery store, if you're selling grocery items, and it's well defined what a grocery item is, that it's only 1%. Litter tax is another one. If you're in a business like a restaurant or a convenience store, manufacture certain products, then you're required to also register for what's called litter tax. So I do want to real quick talk about out-of-state sales tax. If you're selling products outside of Virginia, then there could be tax implications. First of all, if you sell products to another state, you do not collect Virginia sales tax. Definitely don't do that, because that doesn't do any good. The question is, are you required to collect sales tax for that particular state? Well, depends. And I'm going to show you, this is just a map showing you of some of the requirements. Like in Virginia, you'll notice that in Virginia, if you have $100,000 or 200 transactions, anybody who sells into Virginia from outside the state is required to do it if they have more than 200 transactions or more $100,000. So the same applies if you see North Carolina, West Virginia, Ohio, all of those look the same, which means if you're selling any of those orange looking states, then if you're going to be having more than 200 transactions in a year or more than 100,000, then you're going to need to collect sales tax in that individual state and report it. So again, this is something else that if you have questions, though, you think it's going to apply, make sure you check with your advisor and dig more into this. So I want to just cover real quick about estimated taxes. Time's sneaking up on me here. That if for any reason that you're taking money out of the company and it's not having withholding. In other words, you're not an S corporation, you're not withholding money. For most of you, that's all that you're just single members. That if you're just taxed as a sole proprietor, then you're taking money out of the company. It's still subject to tax, but there's nobody taking out withholding or Social Security or Medicare or anything like that. Under those scenarios, you're going to be required to make estimated quarterly estimated taxes. And these are the dates that they need to be done at. And the way that works is it's based on the amount of money that's being taken, that's your tax return says that you made, not how much money you took out. So just a quick example, if your revenue for a particular period was $10,000 and your expenses for that particular quarter was $9,000, your net taxable income was $1,000, where your estimated taxes are going to be based on that $1,000. Okay. So even if you took out more money than that, it's still going to be based on the $1,000. Now, if you're not going to owe more than $1,000 for the entire year, you're not required to make it. But if you're a sole proprietor, you're being taxed on both self-employment tax, which is Social Security and Medicare tax of 15.3%, and you're also being taxed on your personal income tax return for your personal income for both federal and state based on whatever income tax bracket that you're in. So if you're in a 10% tax bracket, you could possibly be owing 25.3% of taxes on that money. So if you took out $10,000, you're going to have a tax burden of approximately $2,500 just for federal. So that means on a quarterly basis, you should be sending in money. I am finishing up this estimated tax class that's also going to be available in the near future, that you can take this class and kind of go through it and learn more about how this works. I don't want to spend a lot of time. I just wanted to touch base for everybody to realize if you're taking money out of the company and not taking tax out, you should be paying estimated taxes. One is so you don't get hit with a penalty, but most importantly, you don't get hit with a gigantic bill in the springtime when you do your tax return. All right, so I'm going to leave this out for the future. All right, the last thing we'll talk about is how to avoid the tax man. So keep proper accounting records. Make sure you're keeping, receipts and things like that, documents, et cetera, et cetera. Properly document mileage, your phone and internet if you're using it for personal and for business, how you split that out so you're keeping track of them. Make sure your tax returns are filed on time. Make sure your tax payments are filed on time. And if you're running payroll because you have employees, double check to make sure those 941 payments and files are being sent in. And if you're collecting meals tax or sales tax, remember 941 payments, and these are payroll taxes, along with sales tax and meals tax. Those are what we call trust funds, which means customers or employees are giving you money and they're trusting you that you're going to deliver it to the correct agency. In the event that you do not pay 941 trust payments or meals tax or sales tax, the government can come after you personally for those. And these are also not bankruptable. So do not feel like, well, I can, I haven't paid them, I'll pay them next month or whatever else, you can get yourself in a load of trouble for not doing that. So just remember, pay those payments. Also, if you receive a letter from the IRS, please open it and see what it says. I've been to clients' businesses and they would have a stack of 30 envelopes from the IRS and none of them were open. So make sure you're opening those envelopes to see what it is. It could be nothing. If it is, just open it and throw it away. But if it's important, open it and see what it says. If it's something you got to do, not opening doesn't change the fact that there's bad news in it. Okay. If there's bad news in it. So you'd rather know that. And if by chance you filed for an employee retention tax credit, make sure you're keeping all your documents to support that claim, because that's going to be a massive program that's going to be audited. And there's going to be a lot of people in trouble because of taking that credit that probably shouldn't. All right. I kind of run out of time. I'm not even going to talk about that. I'll just leave it in there. So with that, I'm sorry I took longer than necessary. I have a cold and I kind of can't talk as well as I should be talking. So why don't you stop recording? Let's go ahead and see what